Crypto markets go to extremes. Once we know the markets go to extremes and we know how to measure it, we can put that on our side. But very few traders wait for that advantage, and fewer still are prepared in advance to really exploit that advantage. And that's what this video is all about. I'm sure you've heard the cliche, cut your losses and hold your winners. This will keep your losses small, but it misses a second factor that every pro trader uses to exploit the advantage of the market extremes for the big profits. Most of your money from trading is going to come from trades that take off rather quickly when you put them on. That's the reason why today's video is so important. Hi, my name is Doug and I'm the creator of digitalcurrencytraders.com and intro-to-cryptos.ca. If you find this content helpful, the only thing I ask for in return is that you hit the thumbs up button and leave a comment down below. It may seem insignificant, but it helps much more than you might realize. We have a lot to cover in this important video, so let's jump right in. As crypto traders, we're after a better return than most would consider fair with any other investment. And yet many trading plans have the trader in a position all the time. The thinking being that the market is either going up or it's going down. Perhaps you've been trading crypto this way and maybe even making 60% correct calls, and yet you're still struggling to grow your portfolio. Often, trying to guess every market move just encourages overtrading, second guessing, and it results in a string of small losses. Without the strategy that we cover today, you will find that trading is not even a 50-50 game. You may win more often than you lose and still never recover much beyond your losses. You see, it's natural to want to take a profit to prove that we are right. But being right in itself doesn't make the most amount of profit. It's important for us to keep a good position as well as to impress upon our own thinking that we have the correct position initially. Maybe you've put on trades and waited for the market to prove that it was a bad position. And when your positions are correct, you may think the next step is wondering when to get out. Well, it's human nature to do it this way, but it's also the source of most trading difficulties. The time to get out of a position is not when the market is proving the position to be a correct one. We have the opportunity to be wrong as often as correct, but when we are already proven correct, this is certainly the time to step off first base. Our first risk control rule keeps us protected from the lack of certainty at the beginning of the trade, and the second risk control rule helps reinforce the certainty in those trades that do prove correct. This is the second part on two special videos on risk control. If you haven't watched the first one already, be sure to go back and watch the video on rule number 1. Without a correct method to keep you in your winning trades and press your correct positions, you will never recover much beyond your losses. When your trade is correct, you must be bigger at that time. This will require a rule or a strategy that's designed around adding to winners in the unfavorable game so that we come ahead in the long run. So here's the rule. Press your winners correctly without exception. It sounds pretty elementary, but correctly is the key. What you hear quoted most of the time is to cut your losses. And cutting your losses is vital for survival, but you need this pro strategy if you actually want to make profits. There will certainly be debate on how to know when to add on to a correct position and how a market can turn a correct position into a wrong position. I'll get into specifics in a later video when I show you the flow chart for the 5 stages of the trade. This is so important because rule number 2 shows up in 3 stages of the 5 stages of the trade. I'll share our most important add-on plan at the end of this video, but first let's unpack this and get a bird's eye view of this pro tactic. Press your winners without exception. Now, just because you have a position in your favor does not mean that you must now add to the position. Correctly means that you have a qualified plan for adding to your position once the trend has established itself. The proper criteria for adding on to positions depends on your time frame and the expectations of your trading plan. Without exception in the rule indicates that it is not an arbitrary decision on the trader's part whether or not to add. It is not optional. Keep in mind that the correct way of adding in one trading plan may not be correct in another trading plan. You might be a day trader trading back and forth, or a short-term swing trader, or a trend trader only. Each trading plan will have a different criteria for adding on. Most traders also want to get out before the market turns and takes away the profits that we may have. We may let losses get bigger because we're wanting to be right and we're hoping the market will reverse. And yet, we may only let a gain get started before we take those profits. Taken together, this will cause your losses to be larger than they need to be, and your profits are smaller than they could have been. Be sure to watch the video on the 2 mistakes that all traders make. It'll help you understand fear and greed a bit better. Rule number 2 states that you must add on to a proven correct position and that it must be done correctly. The rule makes no exception to adding on to a correct position. The intent of rule number 2 is twofold: to reinforce your correct thinking both mentally and your thinking and execution to increase the size of your position. This rule does not tell us how to add. This is your requirement in your trading plan to develop. Trend traders like myself start off small and they get larger when they're correct, but day traders will start off large and they get smaller when they're wrong. These 2 rules are to give you the long-term ability to continue to trade with the least amount of drawdown and the best possibility of making the most money in the long run. Huge drawdown is a critical reason why some traders just go out of the business. You must start your trading plan with rules created to protect your equity, and I'm presenting those rules for you to incorporate into your plan. Experience has proven these rules are a necessity for survival in trading, and they're necessary for reaching the objective of making the most return with the least amount of risk. It's easy for us to focus on the predictions and the potentials in the market and unknowingly put these risk control rules on the back burner. While the last video was focused on rule number 1, the strategies that will keep you trading in the long term, this keeps risk small at the beginning of the trade. But there are times when we want to increase our exposure to the market when the position has been proven correct. We must address rule number 2 as we're creating the trading plan and before the trade is placed. This is a solid rule, and its importance cannot be diminished in trading. Until you actually see the reward from rule number 2, it may be difficult to understand. I believe most traders want to have a certain sized position, and they put that full-size position on right at the start. This is not a correct way to use rule number 1 and definitely not using rule number 2 properly. If you have your full trade size on from the beginning, then your thinking is totally counter to adding on to the trade when it's successful. You should be at least twice as big or larger when you are right than when you are wrong. So you must work that into your trading plan. You never risk it all on the initial position being correct. Other than that, you're defeating these rules. I want you to ask yourself these 2 questions. Did you put on only part of your position from the very beginning of the trade? Are you planning your add-ons prior to the initial trade? If the answer to either of these questions is no, then you must go back and rethink your trading plan. If you can think it, you can do it. By incorporating rule number 2 into your trading plan from the start, you will be eliminating the desire to be proud when the market moves your way and to want to take your profits to show that you are right. Traders love to be right. This is your ego. This is your enemy, the love to be right. Your motivation must be loving doing the right thing in trading, either by reinforcing correctly when your position is correct or removing it if it's not proving correct. You will become the best trader you can be by being wrong small, not by being right small. Get that into your mind now. You have to press your winners if you really want to consider yourself to have the ability to make a living or extra income from trading. Otherwise, face the truth. You're only playing to break even. You must understand that you will not be the one to determine your market's position size. This is going to be the market, and it must always be the market. Rule number 2 is going to tell you to put that trading plan into effect before you take that initial position. I cannot help you with overtrading or being under-margined. You must correct that situation before you can ever expect to be on even ground with the big funds. You must, at all times, be able to put on only a portion of your expected position at the entry and be able to at least double your size somewhere along the route of the expected move. The protection is rule number 1, but the biggest protection is rule number 2. Now I'm going to tell you why rule number 2 is the biggest protection of all. You've all heard that you should not add to a loser. Well, rule number 2 takes care of that from the start by keeping you with a smaller entry in the first place. You never have your entire position in place until you're getting the move that you had expected. Now, why would I encourage you to have half of your total position at the very start of the trade? Well, that's because trading is a loser's game from the start, and you knew that from the beginning with rule number 1. And now with rule number 2, you find that to trade correctly, you were never really supposed to have your full position on at the beginning of the trade. If you can't justify adding on to an existing position, you're probably overtrading. Most of the time, traders don't think about the reason for adding on because we have our full position on from the start. This is the maximum risk right at the start. And this is never what you want in trading. You must take risk, but never your maximum. And this is exactly what you're doing if you're putting on your full position at the beginning. Correctly adding to a proven position must be organized so that the top-heavy trade isn't established because it will ruin a good trade in such a small reversal. Each add-on to the original position should be done in smaller and smaller steps. Here's an example for you. If you had a $6,000 trading account and you plan to put 10% or $600 into a specific trade, put on $300 as your initial position, add on another $200 if your criteria are met, and be prepared with an additional $100 if the position continues with the trend. This will give you twice the original position size when all 3 positions in place. Practice using this 3-2-1 strategy for setting up your full position. And that wraps it up for rule number 1 and rule number 2. I am so glad to have you along in these videos. I'm really looking forward to hearing your comments about these rules because most people don't trade this way. I'm grateful to have you along. Be sure to hit the thumbs up button, subscribe, and hit the notification bell icon so that you get the next videos in this series. And leave your comments down below. It helps shape the videos in the next part of the series. Thanks again for being here. Trade safe and keep those losses small.